Tuesday, the 14th of February. Happy Valentine's Day. Let's get the briefing underway then in terms of what we're looking out for this morning. Overall, not really too much going on at the open this morning. The index futures just marginally lower. However, you can see centre middle of my charts, the pivot levels respectively in the DAX and S&P futures both finding a degree or providing a degree of support thus far to some of the price action through the cash equity open around half an hour ago. The dollar's been a little bit choppy this morning. The dollar index is down 0.25%, so helping elevate euro just a few minutes ago, touching on fresh highs, just looking to pull back some of the downward move that was seen really yesterday afternoon when the US came in. So upside, just looking at R1 at 0649.5. Cable found again a brief look on the downside, pretty much hit pivot to the tick in the futures before bouncing, but broadly flat on the session. As too really roughly as gold. Again, the associated pivot providing a bit of a floor at the moment to keep an eye on. Likewise, oil. It's almost a reverse situation. I guess some of the dollar weakness just helping elevate that asset up to 53.20 on a brief test before finding a bit of resistance. Really not too much in the way of news there, but technically, just having a quick look, you can see the kind of pretty substantial price movement that we've seen at the end of last week. And then also some of the pullback. That was of course, the EIA report that we saw where compliance was seen at above 90% from OPEC nations, which is, again, just kind of ratifying the fact that they're, for the first time in recent memory, really committed to following through with their cuts in production. If anything, Saudi Arabia going above and beyond to make that happen. And some of that being taken back yesterday, and then we're kind of back to really net neutral from where we were before that move. Slightly longer dated though technically on the upside, although it's still about $1.10 away or so. Definitely in terms of the range in which we've been in on the top side since the beginning of 2017. We had the first couple of days when we had some volatility, but really since the 9th, when we broke through that level at 54.34, that's a level we'll be keeping an eye on should we get to the upper bound of these levels. So you kind of got that test of that level on the 2nd, and then also on the 18th, similar as well on 13th, around those points. So if we do start to move higher, obviously go through R1, and then R2 we'll be looking out on the upside, coinciding with around these levels. That could technically be an interesting point of resistance to keep an eye on in the crude market. Otherwise then, let's get our teeth into some of the overnight news flow. Did have yet again another positive finish across the major three indices. The SPU's up 0.5, similar to NASDAQ, up 0.7 in the case of the Dow Jones Industrial Average. One of the headline names looking at the press this morning that you've likely seen is Apple, valued at $700 billion as their shares closed at a record high. So they've overtaken Google once again. It's kind of a jostling at the top of the table really between those two companies. But driven by investor optimism about upcoming iPhone sales super cycle, and hopes that $230 billion in overseas cash might soon be put to greater use. So just explaining that in a bit more details. Essentially, when Apple released their results more recently, we saw for the first time in a long time their key product, the iPhone, in terms of sales growth returning back to positive on the year-on-year on a fiscal quarter after 3 consecutive declines. The iPhone 7, which really was a bit of a flop on its release actually over the holiday season, although it failed on its initial launch to grab people upgrading. What it did do at Christmas was people were buying into the phone as new users, so to speak. And then there's a lot of expectation about Apple to unveil a substantial technological upgrade when the next iPhone comes out, given it will be, I think it's the decade anniversary, so likelihood they've kind of held back on a few things to make that kind of a bellwether phone, so to speak, or a milestone. The other thing, of course, with Apple is quite a lot of people are looking at this, obviously, this phenomenal tax plan that Trump has been speaking about the end of last week. The shape and form that will take is still unclear, but further boosting Apple's share prices, that many investors are hoping that a tax holiday under the Trump administration would allow the iPhone maker to repatriate some of the $230 billion that are currently just sitting offshore due to the high amount of tax. They're very reluctant to bring that in, but any short-term window that gets given by Trump would fuel quite a lot of that money coming back in and then ultimately paid out to shareholders and used to increase its capital return program. So helping elevate the stock for the time being, and when a heavy market-weighted firm like that starts to move, it certainly starts to act as a bit of a positive for sentiment, and equities finishing on the upside yesterday. Other things to be aware of from this morning and overnight press, you've had German GDP. It's coming at 0.4% in the fourth quarter of 2016, slightly below market consensus of 0.5. To be honest, I don't really think that that's having much of a read across or impact onto market prices this morning. Okay, it's a touch softer than expected, but it is up from 0.2% was the final revised figure from the prior quarter. So still some relative strength. Whereas overnight in China, you might have seen this graphic in the fast FT. Let me just make it a bit bigger. So essentially this is China's inflation figures, which came out overnight. And to give you a bit of a time or an axis, on the bottom you've got January 2012 all the way up to January of 2017 to give you the most latest readings. Essentially what you've had in China is producer prices have grown at their fastest pace in more than 5 years last month. Consumer inflation climbed on food and fuel costs. Don't forget, somewhat elevated as well by the fact you have Chinese Lunar New Year holiday, and food prices tend to spike. Things like pork see exceptional price spikes on a seasonal basis around New Year, given the holiday and a lot of spending on food products. But as you can see, the PPI numbers are what stand out quite a bit here. You can see we went through the majority of 2015 and certainly the first half of 2016. PPI was very negative, whereas CPI has kind of tracked fairly consistently around the high 1 to low 2% range. PPI though has come steaming back, if you like, in a really aggressive fashion. If you were to draw a line there, that's a very sharp incline that we've had really in the last 12 months. So a couple of stats here and then a couple of thoughts on this. So the CPI number, what you're looking at there, 2.5%, what was up from 2.1 in December. It was a touch above expectations by 0.1, the highest reading since May of 2014. The producer prices, the PPI was up 6.9%, above the expected 6.5%. And up on the previous 5.5. It's the highest rate of growth in the PPI measure since August 2011. The month's rise helped by a 31% surge in mining products prices. And after 54 months of negative PPI prints, January marked the 5th consecutive month of expansion for producer prices in that regard. Now, I did see some bank commentary on this, and I think this chap at Commerce sums it up quite nicely. He's saying, this comment here, we have not seen significant pass-through effects from PPI to CPI inflation as yet, suggesting that the strong rebound in PPI inflation is a reflection of proactive fiscal policies, given that the Chinese Communist Party will hold their 19th Congress late this year. Local governments are keen to deliver decent growth figures. Against the backdrop, the infrastructure investment pipeline will remain solid. So when people often talk about the validity of growth figures in China, this is often what happens, is that on a regional level, local governments have targets set by the Communist Party which have a big annual conference, and essentially they tend to, in their own autonomous region, almost enact their own fiscal stimulus on a very localized level in order to hit pretty aggressive targets from then the kind of national government, if you like. And so what they're suggesting then is that this is all part of a kind of in-fitting with the political timeline in order to bolster activity on infrastructure investment, which is playing out then in an increase materializing in the PPI, if that makes sense, but it not at this point having a read across into CPI. If it continues to move higher, obviously it might be something to keep an eye on if it does start to creep through into consumer prices. So hopefully that makes a bit more sense with that Chinese data. Overall though, the Chinese inflation numbers not, again, having really a much broader impact on the global financial markets. But certainly an interesting development with the pace of the PPI incline. And if that were to continue going at that pace, it'd be interesting to see where it starts to top. Other things and other headlines to get you up to speed. This is another one. This chap here you might not recognize. This is the White House National Security Advisor Michael Flynn, resigned yesterday amid a snowballing controversy over whether he lied about his contacts with a Russian official. The main point here being that throwing President Trump's security team into turmoil just weeks into his term. Again, this is one of the senior ranking security officials already after really 2 weeks having to resign because of question marks over what he was doing, basically, which Bloomberg were running a couple headlines saying that some of the dollar weakness was pinned on the back of this. I guess their thinking is along the lines of that it starts to call into question the authority of the Trump team that he has around him and their ability to be able to perform. People keep falling into these types of situations. It just means that there's more uncertainty about his ability to deliver, I guess. Maybe that might be what they're putting two and two together to reach that conclusion. I think that's a bit of a stretch, but it does ring true in some degree. Certainly Piers was talking about in the briefing yesterday, a bit of a U-turn in several real Trump campaign pledges to how they currently exist, which is to be watched, I guess, going forward. The big one, of course, will be whether or not and what the details are towards the end of this month, when we'll be anticipating more details on this phenomenal corporate tax plan. Some other headlines, so you're aware, Credit Suisse. I've highlighted this because I wanted to point out the difference between market expectation and the news. So you read this headline, Credit Suisse posts a loss of 2.3 billion on litigation. You would think, I wonder how much Credit Suisse is down this morning. Well, they're up 2.6%. You know, this is a perfect example of kind of price or expectation that the market already has about the performance of a situation, and a net, even though this is a negative in terms of profitability, actually it's not as bad as markets had expected. Also, it's the second consecutive annual loss, so markets are somewhat desensitized to the present situation in Credit Suisse, and most notably what the CEO has said is that the cost cutting is ahead of schedule, and improved market sentiment for banks that's boosted their trading in the fourth quarter has continued to be seen. So often what you see is when there's big litigation charges hurting the profitability, what does the bank's knee-jerk reaction then is to cut costs, cut jobs. That net then is seen as a positive usually for how a stock price reacts in the short term. So important to understand the difference there between reading these headlines and then how they actually play out in the marketplace. Moving on though, today is a lot different from yesterday. And by that what I mean is that the calendar is far more busy, and that will remain the case both Wednesday and Thursday. Talking to a couple of the guys obviously transitioning into live markets for the first time yesterday, it's kind of, you know, when you are a trader and you go on to do this hopefully full time in the future, is that on Monday you should already really have it mapped out where exactly how the week is going to play out in terms of the most probably volume that's going to be seen in the market. Now, if you think about it in terms of a top-level event that's occurring this week, you have Janet Yellen's semi-annual testimony in front of the Senate, which is happening this afternoon. So if I look at the calendar, then you start to layer in a lot of US Tier 1 economic data on Wednesday and Thursday, UK inflation data today. Really, I'd look at Monday and think, well, I've got to be realistic that I don't want to put myself in a negative situation so early in the week when I know that potentially the better trade intraday opportunity might come later. So again, it's a good practice that, well, really at the weekend you want to be prepping this up. All the data calendars are available then, is looking forward to then kind of work out your allocation of how you think the best trade opportunities will occur. That way you can kind of act accordingly. Now, yesterday was very quiet from a scheduled basis. That kind of did to a certain degree play out in market prices. However, as we saw, equities again pushing up to these record levels. But today, in particular, early on, so in around 45 minutes time, you're going to get some UK inflation numbers. Now, these are going to be interesting for the reason that, if I just bring it into shot, the UK inflation rate, obviously last month we saw 1.6%, which marked the highest rate of inflation in the UK on the CPI year-on-year measure since July of 2014. This was above expectations of 1.4, so we overshot the median consensus last time this figure came out. Now the consensus today is for 1.9%. If we overshoot by 0.2 again and print at 2.1, then we are officially above the Bank of England's inflation target. Now, the quarterly inflation report released most recently from the Bank of England was suggestive that over the 2-year horizon, they see the inflation peak kind of around 2.8%. Now, some would say that's a little bit pessimistic on how high inflation might go in the short to medium term. It's going to be the pace of this increase, which is going to increase today, but by how much and how quickly over the next 1, 2, 3, 4 months, that will really determine then a better insight into how the Bank of England are going to need to react, if at all, to tempering sharply rising inflation, if that were to be the case. Because obviously this comes in the context of going into a period of triggering Article 50, which will have the opposite, where there's going to be a lot of fragile sentiment on the negotiations when they open up with Europe. So today's numbers are going to be important for the sterling currency. Just taking a quick look at cable this morning, as I said, you've got euro dollar up around 27 pips, but cable is pretty flat overall. Maybe there's a lack of real appetite to really get involved at this point. Looking at where we're currently trading, I mean, going back to last week, kind of got the high point up at 25.89, which would be just above R2 on the daily pivots. And then likewise, the end of last week on Friday, just below S2 at 24.45. I'd say that's kind of the maximum I would be looking at really in terms of the top and downside range on today's inflation figure. Because to a certain degree, don't forget that most people are expecting inflation to move higher. That means then that most people are already positioned for heightened inflation. If this number came in at 1.6, i.e. the same as the previous month, that would be a big surprise. And you would get very aggressive sterling selling in the short term, an initial fast money move for sure. I'd say the risk then, with the market positioning themselves for higher number, the risk is to the downside. A weak print would see a proportionately larger number than an upside surprise, I'd say, in that respect. So something to just keep in mind in terms of how it will react, at least in the short term. Okay, back to the calendar. The other major thing to look out for today, this morning, you do have the German ZEW economic sentiment. A quick look at that figure was particularly strong last time. came out at 16.6. It was slightly below expectations, but was the strongest level since June of 2016. So just given the context, this morning you've had slightly weaker German GDP. It is interesting to see whether or not this particular data set can keep up momentum. Remember, for the ZEW number, this is a measurement of the level of optimism that analysts have about current economic situation and expected developments for the next 6 months. Again, this is a forward-looking figure, which is why, kind of really second to the German IFO number, which is actually companies and firms themselves. ZEW is the economist's opinion, but the forward-looking is important to determine economic sentiment going forward. So we'll definitely be keeping an eye on the likes of the DAX and the Euro at 10 o'clock when these numbers hit. Other big thing then today, of course, from the US session and scheduled for 3 o'clock our time is this lady. So Fed's Janet Yellen will give her first of 2 appearances she'll have of keynote speeches this week. Today is in front of the Senate, tomorrow the House of Representatives. And this, as I explained to some of you yesterday, is kind of one of the key historical speeches that she will give, or going back in history, aside from the regular set schedule of Fed interest rate meetings. The semi-annual testimonies are used as a real kind of benchmark event for the Fed to communicate their latest insight into monetary policy and also current economic environment. This is particularly interesting because it comes at a time where the market is kind of asking itself the question to a certain degree of when are they going to hike rates next, and also are they going to commit to the 3, or are we going to get a bit of a repeat of 2016 when that pace of rate increases gradually moves more shallow as the year progresses and the Fed continue to in action this cautious, gradual kind of approach to rate normalization. If history is anything to go by, you would argue that probably it's the latter, and the Fed will maintain their kind of existing quite cautious stance. Given the fact that you had Fed speakers, obviously you've had Bullard, although a non-voting member, talking very dovish last week about he only sees 1 hike over the next 2 years, never mind 3 in 1 year. Then you had Fed's Fisher, who's the vice chair, speak at the weekend, talking about significant uncertainty about the fiscal policies of Trump, mean that the Fed, it's very difficult for them to make any kind of judgment about the impact that that will have on the economy, which if anything should be more positive. It should be more of a threat to increase rate trajectory. It's almost the opposite. A lack of clarity from Trump on that at this point means that the Fed likely to just hold course at the moment. A couple of comments out of a few banks this morning on this subject. Barclays saying they expect Yellen to reiterate her message that the economy is close to full employment and inflation has risen, but remains short of the Fed's target. Bank of America saying that they expect Yellen to reiterate the Fed must proceed with a gradual hiking cycle. They expect her prepared remarks to sound familiar or similar to most recent speech, noting the labour market has tightened, wage pressures are increasing modestly, likely to note the Fed are making progress toward its mandate of full employment price stability with core inflation approaching the target. So overall, I guess, we'll go into this in more detail this afternoon. What the market might look at as a key measure to gauge whether this is hawkish, dovish or neutral is March a live meeting? Now, asking yourself that, you'll have to look at what the fixed income markets are pricing in. This is when you look at STIRS, short-term interest rate futures, which are highly sensitive to fluctuations in rate expectations, and federal funds rate futures are pricing in on the CME FedWatch tool tracker only around a 13% probability of a rate hike occurring in March. Really, the majority are expecting June, which is the next period of when the Fed would release their summary of economic projections with a press conference with Janet Yellen, as the most likely time that they will act. The Bloomberg measurement tracks normally slightly higher That's up at around 30%, but still a low probability that March will be the case. If she says March is a live meeting and says those specific words, I'd actually think that in a knee-jerk kind of real-time reaction would be deemed as quite hawkish, and then I'd expect her statement to then sound quite dovish, if that makes sense. So it'll be like a hawkish comment with a dovish statement, and that net keeps all options on the table, which could be a very viable option that the Fed normally want to do. Although unlikely to act in March, they don't want to completely remove it from the market psyche. So what do? You say March is live, however, we will act cautiously. There is still a lack of information on the fiscal side, which means that will cloud our judgment to make informed decisions. We will continue to assess incoming data, so on, so forth. That's probably how I'll see it playing out. If she is deemed then overall the prevailing theme is quite dovish, then you'd be expecting that to read across into helping elevate equities, or at least keep them at close to these record high levels, on the premise that this is really what we saw lift markets last week. That in combination with the corporate tax comment from Trump, the kind of low interest rate environment for the foreseeable future is a net positive for US equities. Okay. Just had a question as well, just seen in the chat, about what tier is the UK data. For sure, this is tier 1 economic data. When you're looking at assessing what it is that the Bank of England are most concerned about in terms of the metrics that they measure the UK economy by, let's take the jobs situation, which I think we've got UK jobs data tomorrow. No one cares about the job situation in the UK. Unemployment is actually in a very healthy situation in terms of unemployment's very low in the UK. So by default, the Bank of England are not looking at that as a determinant of how they're going to change monetary policy. What they are looking at is inflation, and that is key. So that number today I would classify as tier 1, and you'll need to be watching closely for FX traders. Okay guys, coming up to 9 o'clock, so I'm going to leave it at that. So have a good day and enjoy your evenings, whatever you might be doing, and I'll catch you in the chat room. Thank you.